Hi, Brett Aiken here, publisher of Stansberry Research. Thanks for tuning in. If you're anything like me, you've read or watched your fair share of financial news this week and likely logged into your investment account several times. For months, the markets were calm, repeatedly hitting new all-time highs. But in the last 3 or 4 trading days, panic flooded the market, with the VIX index seeing its third highest spike ever. Fears of a recession, frustration with the Fed, a massive tech sell-off, and mentions of the yen carry trade were suddenly everywhere. Japanese stocks saw their worst day since Black Monday of October 1987, with the Nikkei falling more than 12% in a single day. Bloomberg reports $6.4 trillion has been wiped from the market. They're calling it the Great Unwind. We hope that after you checked your accounts, Stansberry Research was your next stop. Remember, this isn't our first market sell-off. We helped our members get through the dot-com crash, 9/11, the global financial crisis, the 2010 flash crash, Brexit in 2016, and the COVID crash. That's why today, in addition to our daily, weekly, and monthly market coverage, I've asked some of our top financial minds to speak candidly about what's happening. I also asked our founder, Porter Stansberry, to dial in from his vacation. He jumped at the opportunity. You might remember Porter penned his first Friday Digest in years back in early July. He wrote, "I think the top is in for big cap tech." And man, was he right. Today we'll hear what he's thinking now. I've also asked senior partner Dr. David Eifrig and senior analyst Whitney Tilson to join in. Doc was on the trading desk back in '87, and Whitney famously called the bottom of the market on 60 Minutes back in 2008. Guiding the discussion is Matt Weinschenk, our Director of Research. He'll make sure our analysts spell out exactly what you should be thinking about and doing with your money right now. He'll also have the analysts answer some of the questions you've sent in over the last few days. Our promise to you has always been to provide the information we'd want if our roles were reversed. And these are some of the first people I call when I have questions about the market. In short, you're in good hands. And this is just one of the many ways we'll be here to guide you through this uncertain time. Don't forget, we read every piece of feedback that comes into our office, and our member services team is always here to help you navigate our research suite and tools. Now let's hear from the experts. Thank you and take care.
Hello, and welcome to our emergency market briefing. I'm Matt Weinschenk. I'm the Director of Research here at Stansberry Research. And as our publisher, Brett Aiken, just told you, we've convened the top minds at our firm to come and talk about the recent market action. So today I've got Porter Stansberry, Dr. David Eifrig, and Whitney Tilson with us. All right, so where are we in this market? It's Wednesday morning when we're recording this. The market's down about 7.5% off the July high. That's not the largest drawdown that any of us have been through, but when you combine the high valuations on the market, the concentration in tech stocks, big spike in the VIX, and that big down day on Monday, it feels like a time of stress for our readers. So we wanted to reach out and let you know what we think today. So Porter, I'm going to start with you because your name's on the door, but also because you you predicted specifically that this would happen recently. On July 12th, you wrote an issue of the Stansberry Digest in which you said, "I believe we are at an important peak in equity prices, that a big decline in stocks is inevitable, and that buying tech stocks here will lead to poor returns for at least a decade." So Porter, just open question. What's going on? What's your story of what's happening right now?
Well, it's all in that digest. Stocks are historically overvalued. They're trading at levels that we've never seen before at any point in market history. So they're, on various measures, whether it's the Buffett indicator, or whether it's the Tobin's Q factor, or whether it's looking at earnings. Just as an example, Uber, which is a very good business, is a $100 billion stock that's trading at 100 times earnings. These kinds of levels in the largest stocks, particularly in the tech stocks, are trading at prices that dwarf even the bubble of 2000. And so it's just not hard to imagine that the market is going to be disappointed sooner or later by these businesses and their earnings. And that it's gonna, I think we're gonna have at least a decade where they have to grow their earnings in order simply to validate the valuations we see today. And that doesn't really leave much upside for investors in those stocks for at least a decade.
And Doc, you too published on July 18th an issue of Income Intelligence, and it's specifically about how investors cannot buy Nvidia here and they have to stay away. And that was just 2 days after the market peak. Are you telling the same story?
Yeah, I think it's an identical story. I would like to point out to subscribers and listeners and watchers that we grabbed Whitney. He's on vacation in New Hampshire, and Porter is on vacation on the shore on the East Coast, so isolated that we can only get him by audio. But I'd also like to point out we published on July 18th. Porter published his digest on July 12th. The peak was on the 16th. So I'd like to just imagine we were a few days closer to Porter than calling the peak on this. But
Porter was first, though. He was earlier, so he was ahead of time.
But in all seriousness, if I throw up, I have this slide here it relates to sort of what's called the Buffett indicator, which is the Wilshire 5000 relative to GDP, and you can see it's really at all-time highs. So yeah, I think things are overvalued. We'll get into that, more of the questions later and more of the commentary. Whitney, you're connected to the Buffett indicator in many ways. You care to comment on this slide or give your insight into tech and Nvidia at this moment?
Well, that's one of the many indicators I use, and this slide shows what Porter said, that stocks are richly valued. You have to keep in mind that the Wilshire 5000 is dominated by the 100 biggest stocks, which in turn are dominated by the 10 biggest stocks. And so if you compare the 10 biggest stocks today, Alphabet, Meta, Microsoft, Apple, Visa, etc., those stocks are very different from the biggest stocks of 20 years ago and certainly 40, 50 years ago. Big capital intensive businesses, the oil companies, General Motors, AT&T. So stocks today should trade at higher multiples, higher valuation than they did historically. So you just have to be wary of historical calculations when you're talking about vastly different economic characteristics. When I look individually at a lot of the biggest stocks, I'm seeing overall, I would say, rich valuations, but not bubble territory. So I see rich valuations. I see the economy clearly slowing, something I warned my readers about a week ago. Everyone except the 1%ers in today's economy are struggling now. Inflation has hit them hard. And so a lot of businesses, take McDonald's, one of my favorite businesses, is clearly seeing a real slowdown. So generally speaking, as an investor, if I were a trader, I would be moderately defensive right now. But if you're a long-term investor, you own the S&P 500 index, you own good quality blue chip stocks. This is now the 29th pullback of 5% or more in the markets since the sort of generational bottom in March of 2009 at the bottom of the global financial crisis. And I'm fairly sanguine, actually, that like the previous 28, this one will prove to be, I don't know whether it's a matter of a few months, might be a year or so. I make no short-term predictions, but long-term investors, I think, should hang in there.
So you've got a pretty constructive view on the market there, Whitney. Porter, I want to ask you one specific reader question we got a flood of. In your digest, you predicted that Nvidia itself would fall by as much as 50%. I think it's down 30 now. You still sticking to that? You think there's more downside from this point, even after this pullback in big tech?
Yeah, I think that I think what I wrote was that I know that I wrote in several places. I don't remember if it was in this digest or not, but I wrote that I expected the Mag 7 and also the triple Qs, so the largest tech stocks, to fall by at least 50%, and I would put Nvidia in that category. I think it could certainly fall more than 50%, but I think a 50% minimum. In other words, I wouldn't really even go sniffing around large cap tech until there's been at least a 50% correction.
And by the way, Porter, you're not, this isn't so unusual. It was only 2 years ago, in 2022, that the Magnificent Seven, probably off the top of my head, declined almost 50% on average, led by Meta, which was down 80%. And at that point, I know I was, and I think we all were pounding the table that they were screaming buys at anywhere near the bottom.
That's right. These are really good businesses. Some of them are extraordinary businesses. And my problem, as you know, Tilson, is not the businesses, it's the stock prices. And stock prices more often reflect emotion than they reflect intrinsic business value. And I think that the euphoria over the gains in artificial intelligence and the build out, probably a once in a lifetime build out of computer centers, has people forecasting, endless years of 100% revenue growth for Nvidia. And I suspect that those people will be disappointed. But in any case, I don't think you're going to get rich by buying a $3 trillion business that's trading at 60 times earnings. I just really strongly suspect that that will lead to very big disappointment. And so I suggest you just stand aside and just wait until the market emotion changes. And when the market emotion is predominantly pessimistic around great businesses, then you get wonderful opportunities to buy them.
And so if we have all these challenges for these large caps tech stocks, is it possible this is just going to be a broadening of the market? In early July, small caps went on a good run, which they haven't seen in a long time. Now they've given most of it back, but do you still have a bullish outlook on small caps or other parts of the market that maybe don't have such troublesome valuations?
Absolutely. There's always a bull market somewhere. And, I think that there are several legendary businesses where the market's mood is very pessimistic. I would point out Nike. And I think there's also many good growth stocks that have incredible economics that are relatively cheap, like Philip Morris. And of course, there's always industries that are in or out of favor. And lately, biotech has been very out of favor. We've been writing about the incredible opportunities in small cap biotech for all year. And I think we now have more than a half a dozen different recommendations that have gone up by more than 100%. And so there's always opportunities in the markets, and you don't have to only buy the 10 largest stocks. And I would recommend that you not buy them because they're incredibly, historically, unprecedentedly overvalued. But I don't have all that much hope for the S&P 500 because so much of that index is now dominated by the 10 largest stocks, and those 10 largest stocks are very overvalued. But it is also true that the bubble in this market is highly concentrated into those Mag 7 stocks and the 10 largest stocks and the triple Qs. So if you can simply avoid things that are that are valued at over $1 trillion and that are trading at more than 50 times earnings, you'll probably do okay.
Or Nvidia still at 32 times sales. Whitney, I want to, you're optimistic, I think, here in this group right now. Although, Matt, I think on your business card it says perma-bull. So I'll come back to you in a minute. But I want to go up to this this slide here. The CAPE price ratio, Matt, you're a master's in econometrics. This is a weighted smooth average of this. This is kind of like close to all-time highs going back to the 1900s, late 1880s. Whitney, are you still as optimistic and positive when you see this, or do you throw this away in the trash? What do you do with this? Because this speaks to Porter's sort of the overall market richness.
Yeah, well, keep in mind, this is the Shiller's, Professor Robert Shiller's index that he developed. It's a useful tool, and keep in mind, it's taking smoothed earnings or averaged earnings over the past 10 years. And I'd have to wonder how much it is influenced. The earnings number is deflated by sort of the one-time pandemic shock. Basically, so this says the market's trading at 35 times trailing average 10-year earnings. I tend to look at this year's current earnings. We're already slightly more than halfway through the year. We're trading at about 22 times, which on using that metric, again, that's a fairly rich multiple, but it is certainly not bubble territory. Given that the economy's been quite strong, inflation's come down quite a bit, the U.S. economy on a macro level has done better than any major economy in the world since the pandemic on basically any metric. So I think it's important not to get, and the economy is definitely slowing, that is for sure. Investors this past week sort of freaked out with a slightly weaker than expected economic report, particularly on the jobs numbers last week, freaked out that we're in for a hard landing. I still think we're in for a soft landing / an economic slowdown from white hot levels to merely strong. So my general economic outlook is reasonably sanguine, and therefore, 22 times this year's earnings for the S&P 500. Again, I tend to agree with Porter that you're not going to get great returns out of that. We are in the top 10% of S&P 500 multiples today, and historically speaking, investors who just bought the S&P 500 index when it was in the top 10% earned 4% compounded returns over the next 10 years. Now, that's almost exactly the amount you can earn buying a 10-year treasury today. So I don't fault anyone who wants to take some money, a bit of money off the table, particularly if it's in a tax-free account, so you don't owe big capital gains on it, and shift, instead of being 80% equities and 20% cash, if you want to move to 60-40 with your long-term money, you're at least getting paid a decent amount of interest on the cash. But again, I don't think we're in bubble territory across the whole market. I do think certain stocks, particularly the most richly valued one, big cap stock out there, Nvidia, may well turn out to be not a complete bust, but something like Cisco back in 1999-2000, when, just like Nvidia, it became the most valuable company in the world briefly, and basically then declined by 80% and was effectively flat for, it's still, to this day, 25 years later, has never recovered its 1999 peak, even though the underlying company has performed quite well. So I tend to share the cautions about Nvidia. I tend to not, unless I see a major bubble bursting across the entire market, like the internet bubble, like the housing bubble. The rest of the time, I think the average investor investing in blue chip stocks or index funds for the long term should mostly ignore the short term noise.
Fair enough. Matt, I do want to come back to you for a second on that. Can you, as easily as Whitney did, brush off the cape and go from a 10-year smooth to 1 year? And where are you? Because again, you've been super optimistic in my however many years we've been together.
Well, I wouldn't call myself super optimistic anymore, but optimistic a little bit. I just talk about the CAPE ratio. If you run the numbers on that, it doesn't tell you what the market's going to do in the next year. It's essentially random. 3 years, you get a little bit. But when you go out 5 to 10 years, you can get a pretty good prediction of the returns from the CAPE ratio. So CAPE, where it is now, it would tell you 10-year returns on stocks are going to be about zero, which is not too enticing if that relationship holds up. But a lot of these indicators, CAPE included, are essentially broken by the concentration of those big stocks at the top of the S&P 500. And when they came up with indices and index funds like this, they're supposed to be diversification at a low cost, but now they're concentration at a low cost. And they didn't expect people to be putting so much money into these indexes, which when people put money into the index, it goes to the biggest stocks, the most highly valued stocks in there. So a lot of these measures they have different dynamics now because of this concentration that we've seen. So I would say CAPE ratios telling you zero-ish returns for the next 10 years, but that's skewed a little bit. And like Porter was saying, I think there's lots of other opportunities in other sectors, in cheaper stocks, in things that aren't priced for 30% growth a year when you're already a $3 trillion company, which is just insane. So,
crazy, yeah.
That's what I take from the CAPE ratio.
And then Whitney alluded to this, the job opening number that scared everyone or maybe started this, catalyzed things. You see this here on this chart, really coming off fairly hard from the top. Do you give any credence to that? Or Porter, do you worry about the economy? And are we right at the beginning of recession? Are we amidst the recession? Thoughts on that, Matt or Porter?
I'd like to hear what Porter has to say. So, you're asking, okay, we talked about the market. What do you see in the actual economy itself underlying it? Porter, what do you think there?
I think that there are some very significant economic headwinds that we're going to have to tackle. But this is always the case. Anytime you look at the economy, there's always problems. The problems right now are we have big problems in commercial real estate, and those problems have not been addressed. They haven't been dealt with. There are going to be some more banks that fail. There are going to be a lot of commercial backed mortgage bonds that go belly up. There are going to be some big losses, not like the housing bust losses, not trillions, but many hundreds of billions of dollars have been lost in commercial real estate, and that hasn't been marked to market yet. So there's going to be some slow to credit growth, which will impact the economy. The other thing I see is that the bottom half of America is out of gas. You see this in McDonald's earnings. You see this in Dollar General earnings. You see this in slowing retail sales. And you see this, I think, also in really big reductions in prices, which we haven't seen in a long time. So you see, look at used car prices, for example. These are all signs that the American consumer is really tapped out. And you see that in soaring credit card default rates. You see that in soaring auto loan default rates. These are all signs that we are going to have a recession. I would argue the opposite that Tilson's argued, of course, respectfully, and with the knowledge that no one can know. But I think we are going to have a very long and deep recession. I think we'll see recession-like atmosphere for the next 4 to 6 years. And I think there's a lot of bad debt that is going to have to be dealt with. How it gets dealt with, we all know what will happen. They'll eventually turn on the printing press again. And when they turn on the printing press again, that'll be a good time to own stocks. But between now and then, I think you are going to see generally better returns in fixed income. So I am really interested in distressed debt right now. I think that where there are problems like in commercial property, that also means there are incredible opportunities that will emerge. And so I'm really looking forward to distressed debt over the next 18 to 24 months. And of course, when you have low interest rates in a recessionary environment, you have opportunities in things like housing and in biotech. So again, there are ways to invest through this recession, but I do think we're going to see unemployment go up. I think we're going to see prices continue to be weak, and I think you're going to see a lot of problems in credit.
Yeah, one of the things that strikes me is the housing bubble. I've put a chart up here which integrates housing prices and inflation, and that spread has just gotten, in my mind, crazy out of line. And then the income needed to buy, the affordability for the average person, in my mind, again, is off the charts. And I think with unemployment continuing to worsen, I've thrown this chart up the last couple of years at our Alliance meeting, which makes this connection between market peaks and unemployment, and it's turning up quickly. And I would say I'm as bearish as I've ever been, and a whole bunch of reasons. You look at consumer economic conditions as reported and surveyed; those are, if not all-time lows, they're close to it, and that's problematic for both the economy and this belief that you can have this whole list of companies that are trading at 20 plus times sales, which when I was getting my MBA, that was where the most extreme launched biotech drug companies were trading, and you were thinking that was expensive, and now we've got this belief in technology and AI specifically. So I'm probably the bearish of all of you, and I'm not certain yet where opportunity is. I know where maybe I might be protected. Go ahead. I've sort of taken and stolen this from you, Mac. Go ahead.
I wanted to ask Whitney. Whitney, you follow Berkshire Hathaway extremely closely. Warren Buffett just sold off a huge stake in Apple, which might have been for diversification reasons, but you've also pointed out that he may be seeing some signs of economic slowness because of what he can see sitting inside Berkshire and all his operating businesses. What's your read on that situation? Is Buffett getting ahead of something here, or what do you think he's seeing?
Yeah, I would. My guess is it's 80% stock specific and 20%. Now seems like, and by the way, when I say now, this was back in the second quarter, seems like a reasonably good time to, lighten up a little on equities and build what is an unprecedented $279 billion cash pile today. Keep in mind, Apple, he has owned it. It's been better part of a 10 bagger for him. It became a supersized part of Berkshire's portfolio, up to 44% of Berkshire's portfolio. And he had been trimming it here and there, and it actually trimmed a bit of it in the first quarter in particular. And I think, the stock continued to be strong. It was part of the Magnificent Seven. Basically the average stock in America, across 5,000 stocks was flat, but the big tech cap stocks, big cap tech stocks were up 20+%. So, he sold into some tremendous strength there in the sector, and Apple stock particularly, and sold the position down. It's still a 28% position as opposed to a 44% position, unless he's, continued to dump in the third quarter. We don't know whether that's the case, but I actually suspect it won't be, that he's now got it down to a comfortable position size and all. Now, as to the other, so it was 80% company specific. The 20% is you look at Berkshire Hathaway just on Saturday reported its second quarter earnings, and basically outside of its insurance operation, which is not connected to the economic cycles, the railroad business, utilities business, all the retail business, as he doesn't break them all out by business, but in terms of each group that he does break that out, showed declining year-over-year earnings. So Berkshire, Warren Buffett, through the better part of 100 Berkshire Hathaway subsidiaries selling everything from bricks to boots to underwear, has his finger on the pulse of the American economy. So I'm sure he was one of the first ones to pick up on the slowing economy, and that probably influenced his decision a little bit on the particular timing of what he was always going to do anyway, which is take some profits on that Apple stock.
Hey Whitney, it's Porter. Can you I know you're the Berkshire expert. Can you recall a time before where Berkshire had so much in cash as a percentage of its net worth?
Yes, actually, in my daily on Monday, I found a chart that showed it wasn't a percentage of assets. It was done as cash as a percentage of Berkshire's market cap, which, by the way, 279 billion. Berkshire's market cap is approaching $1 trillion now. So it's about 30%. Now, historically, 20% is totally normal, and there have been a few cases where it has risen to 30%. But let's keep in mind, that's not 50% or something, completely out of the ordinary or complete defensiveness.
So it's on the high end, but it's not unseen before. Okay.
Yeah, it's sort of what I'm seeing across the market. Stocks are high, but not extreme bubble territory. And I've found, economists have predicted 10 of the last 2 recessions, and you just have to be careful to not get spooked out by short-term, market moves and all the doomsday predictors and so forth. There have been really 2 times in the past 20 years when I correctly saw a massive bubble building and got very defensive around the time of the internet bubble early in my career, 1999, early 2000, and then again around the housing bubble building into 07, 08. I didn't see the COVID crash coming. I played the bottom of it perfectly, but I did not, anticipate how bad that was going to be. But that only lasted for about 6 weeks and then quickly recovered. Today, I don't know, I call it my Spidey sense, just my gut that things are about to go off a cliff. And again, with all due respect to Porter, his Spidey sense is tingling. Mine isn't. I think we should prepare for 4% returns in stocks for the next 5 or 10 years, but not negative 20% or 50% total returns, based partly on the data that I'm seeing out there. But eventually, all of this sort of comes down to your experience, your instincts, your gut, what I call my Spidey sense. And so now my Spidey sense is a little different from Porter's and Doc's right now.
Well, I have 2 comments too. It could be that, those returns predictive, 0, Matt, you 4, that's on the S&P 500, let's say, where the overvaluation of the big ones drops, whereas if you're picking nice smaller caps, those things could double and triple. Let's talk about that. I want to hold you to the fire on this. Your logic, I saw a flaw. You said Berkshire's not defensive, but then you described his 30% cash, percent of market cap. This is the most he's ever been. So are you
No,
saying
it's not the most, but it's at the high end.
Okay, but isn't that defensive?
Yes. The question is if he had sold all of his stocks off pro rata by 20% and raised a bunch of cash, that would send to me a different signal than just taking reducing a super unprecedented size position down to just an extremely large position.
Fair enough. Well, I don't know if I saw it or read it or imagined it in my sleep last night that he did raise some money on another stock, a large amount, but I literally could be.
He did sell down some B&A, but he did not do an across the board stock sale.
He has sold banks heavily.
Yes.
I think he is now completely out of Wells Fargo.
Yeah.
He's been selling Bank of America.
Yeah.
Other bank stocks he's exited.
And I agree with you on that, Porter. I actually must have been at least 5 or 6 of my dailies in the spring, because bank stocks, and particularly regional bank stocks, were trading at a historically large discount to the S&P 500. And that's the kind of thing that makes my value investing heart beat rapidly. So I took a careful look and brought in an expert who a friend of mine who prefers to remain anonymous, but is the leading bank analyst that I've known in my 20 plus year career. And he walked me through it, and he raised a lot of the same concerns you did, Porter, about the banks have still not gotten this pig in the python of the big losses they're going to take on commercial real estate. He's not predicting calamity, but he thinks banks are going to have to hold lots of excess cash and equity to offset losses. That's going to keep their return on equity and their profitability muted. So he did not see, and I agree with him, and I agree with you, that the bank stocks as a sector look sort of like a value trap today. They appear cheap and are historically cheap, but do not represent an area in which I'm spending a lot of time looking these days.
Yeah, speaking,
Doc,
yeah.
If I can just jump in, I want to position myself somewhere between where you are on the economy, super concerned, and where Tilson is sort of copacetic. I just want to reiterate, I do not think we're going to have as strong of an economy as everybody else does. I think we're going to have a recession, and I think it's going to be a long and lingering recession, mostly because you're going to see a lot of fiscal stimulus. The government is not going to stop spending. At the same time, you're going to see a lot of monetary and credit taxing the growth, because you're going to have a big problem with commercial real estate, and because the U.S. consumer is tapped out. And so I think what you're going to get is an economy that has higher than expected nominal rates of growth, but has much lower than expected real rates of growth. And so that's going to be a difficult economy where it'll be hard for stocks to maintain a high multiple. And so what I expect is a very significant retreat in the overvaluation of the 10 largest companies. But I don't think you're going to see a situation where you can't make very good returns as an investor if you're simply doing a reasonably good job and buying good companies that have good prospects at a reasonable price. So I just want to reiterate, I think we're going to see a difficult economy, and I think that the big cap stocks will disappoint investors, but I don't think we're going to see a 50% wipeout in the Wilshire 5000. I just think you're going to see very poor returns in the large cap stocks.
Yeah, and I appreciate the clarification. And on the banking sector, if they're making money from, let's say, consumer and commercial loans, if you look at this chart here, which shows current economic conditions, and this is a survey, but it's down at 62.7. And this thing averages over its life, going back, to the 50s, up in the 90s. So the consumer, current economic conditions, the consumer is feeling terrible and bad. And whether that's coming out of COVID and the weirdness of that, whether, whatever it is. Anyway, the consumer confidence, same thing. That's at 78. The lifetime average on that is up in the high 90s as well. This is the second chart. And then to, your point on real estate and commercial real estate, this is a chart that scares the daylights out of me. This is delinquency on multifamily. This is a Freddie Mac report. That's at all-time highs. So multifamily housing, which, it's a good part of America, the delinquency on that is shooting off the chart. So I'm also worried on banking, but I'm worried that the consumer is just dead in the water, and then they're gonna get hit from all sides. People in the commercial real estate space. So, yeah, I mean, I'm Matt. Where you're looking at me kind of funny, but what's your take on that, or in the sense of?
Well.
Hey Doc, can I sorry to
No, go
interrupt,
ahead,
Matt.
Porter.
Can I jump in just one thing about real quick about commercial real
Sure.
estate? Did you guys see that the Blackstone Mortgage Trust cut their dividend? I think they cut it in half. Is that correct? Does anybody know off the top of their heads?
I think that's right. Yeah.
Yeah, I mean, so this is the Blackstone are the smartest people in the entire world when it comes to commercial real estate. And they built that instrument to be absolutely bulletproof. So all of those loans and that trust were made at less than 50% loan to value ratio, and they all had matching financing. So whatever the duration of the commercial real estate mortgage was, Blackstone had matching funding, and it was all variable rate. So there was just no way to get upside down on that entity. And even that entity is now down probably 50% and has had a 50% cut in the dividend. And my point about that is if Blackstone is down 50%, then everybody else in that space is going to be down 90%.
Yep, I agree.
Yeah. By the way, Porter, I just Googled it while you were talking. They cut the dividend 24%, which knocked the shares down 10%, citing problems with empty office spaces.
Yeah. I mean,
how far off the peak is that stock now, Tilson?
Yeah.
How far down?
It'll take me a minute to pull it up while we are looking here.
I had the high in that stock around $35 a share, and I think now it's down around 20.
Yeah, that sounds right.
And just to cover the base,
I'm surprised it's not down more given the carnage in the commercial space.
Right.
Well, they're the best in the world at it. But my point is, even it's just hard. I really don't think we have even begun to see the real impact of the collapse in office. We're not even the opening innings yet. This is kind of like, remember the housing bust really started in 2006 and it didn't hit Wall Street until the late 2008. We're in 2006 and the commercial troubles right now. We're beginning to see a huge rise in delinquencies. People are mailing back the keys. A friend of mine from my hunt club in Maryland is the guy who handles all of the foreclosures on office space for a very large regional bank that's headquartered in Maryland. He says that he's now getting keys back each week. So every week, another commercial office is sending the keys back to him, and there is no bid on any of these buildings.
Yeah.
No bid.
Yeah. I did look it up while you were talking. Blackstone Mortgage Trust actually has been public all the way back to 1984. So this is one of the stalwarts of the industry in terms of longevity, and also Blackstone is the bluest of the blue chip in the real estate space. The stock got up to 40, got knocked down to 15 right when the pandemic hit, recovered up to 30, and today it's 17.58. So it's down by almost half, over the past year or so, as people have become aware of the pressure. Now it's currently yielding 10.68%, but that's a number I think that doesn't factor in the 24% dividend cut they just announced last week. Even so, it's still yielding 7+%, but I'd be wary of that dividend. I'm not sure how sustainable that is.
Yeah, and the transactions in that market, it transacts so less frequently that the lag that Porter pointed out that happened in housing before the market really caught on, it can stretch out even longer because of the way that market operates. So this is going to be something,
and you have to be careful of things like this because, there's mark to market, then there's mark to model, and then there's mark to myth. And when you own a whole bunch of real estate properties like this, you can market wherever the heck you want and delay taking losses and so forth, which gives you time to, to the extent you've got a pig to work through the python, to the extent you can sort of spread it out. These guys have the ability to do that, but investors should certainly be wary of it. Can I actually add in, Porter? You said something about 5 minutes ago that I wanted to add to, which is about whether you're right or I'm right. I think we would both agree. I agree entirely with what you said, which is sort of the Nifty 50, the most popular tech stocks, the ones that dominate the S&P 500 today, aren't likely to be the market leaders going forward. And I've been putting up a number of dailies, a number of charts in my daily emails in the past month or so, showing that value stocks relative to growth stocks and smaller cap stocks relative to the mega cap stocks are trading at 25-year lows on a relative valuation basis, going back to 1999. And that was the year I started my first hedge fund. And for the next 7 to 10 years, value stocks and smaller cap stocks outperformed what was back then a very similar looking Nifty 50 bubble, tech stock bubble led by the Nvidia of that day, as I mentioned earlier, which was Cisco. And the outperformance wasn't small. Over the next 5 to 7 years, off the top of my head, small cap stocks were up 75% and large cap stocks were up 13%, right? So large cap stocks didn't collapse, though they certainly got hit, particularly tech stocks, obviously, as the tech stock bubble imploded from March of 2000 through October of 2002. But as long as you were in value stocks and smaller cap stocks, the economy had a recession in there. The tech stock bubble and the Nifty 50 stock bubble burst. Yet still, my fund did great. Value investors, investors in investing, finding really great smaller companies that weren't as popular in the market. We did great during that period.
Yeah, this I think goes to, I don't know if you heard David Einhorn a few months ago talking about how the market was broken. And I think what he was talking about, he's a value investor. I'm sure you know Whitney. Yeah,
good friend of mine.
Right. And he was talking about how it's, again, you go back to these index funds, and when index funds were on the rise and people were putting more money into them, there was all this academic literature about how much can people really put in there. And then you have the other portion of active investors. And what portion of active investors do you need to have proper price discovery in markets, right? And sort of the literature said, you only need 10 or 20%. It's actually, you don't need all those people picking stocks. But as it's grown, I think it's recently crossed about 50% are in passive index funds. As that's grown, you can see that the money that comes in just goes to the highest valued stocks, and no one at all is paying attention to value, small cap, and small cap value. It's completely forgotten. There's no price discovery. There's no one figuring out what these businesses should be worth. And I don't know what the catalyst is going to be to actually turn that around, but it looks like it's really gotten to an extreme.
And I think the moment of entry into those is ahead of us, because I think we're going to still have to see an economic, and I hope it isn't a depression, but I think we're going to have to see an economic recession and struggles in many, many areas, from service sector to manufacturing. But as Whitney led off, America is a really great place to be. It still is a great place to be. And so if you can be, when that starts to turn or bottom, and maybe it's a year out, depending upon, the new, whoever's elected president, Congress and all that, how that figures into this. And rates, I think, have to go a little lower. I think inflation probably is controlled if government stays away from trying to manufacture job wages for no service or no goods. If we can hold away from that, but I'm one of the statistics that I like, and it's out there. It's nothing unique in the sense, but the 10-2-year Treasury yield spread I've put up here, when that goes positive, and it's been negative for a year and a half, that tends to be a time where we go into recession. I think this is signaling that, but the length of it could be short. You'd have to have the workouts in the commercial real estate space. But if inflation does get down there to 1%, I could see that happening, especially if you look at housing charts and how housing prices, those really have to come back down to reality. I'm optimistic, but I'm not optimistic for probably another year and a half, and would be defensive. So the question about small cap and value, for me, not quite yet.
Yeah. Did you guys have anything on small cap value? It sounded like you wanted to pipe in.
Well, let me give an example of the kind of stock that I'm looking at. This isn't an open recommendation, but 2 weeks ago I dedicated two of my dailies to a retailer called Five Below. They sell goods, cheapo goods to teenagers and low to moderate income customers. And the name Five Below comes from the fact that most of the items in the store are priced at $5 or below. And it's been an incredible growth story. The stock was very popular. Every analyst recommended it, and it was trading at 35 times earnings just in January of this year. And I was down at the ICR retail conference in Orlando. I saw them present. And then I saw another retailer, Boot Barn, which basically sells Western themed cowboy boots and denim jeans and cowboy hats and stuff to middle America. And that was trading at 12 times earnings. And I said, and we actually had an open recommendation in Boot Barn from my visit a year ago in one of our newsletters. The stock's done great. It's a good, solid growth company, and we weren't overpaying for it. And I said, Five Below is a great company, but 35 times earnings for a retailer of tchotchkes, that doesn't make any sense. Well, here we are today. Five Below has encountered a slowing of the consumer that we're seeing across the board. They've made some internal missteps as well. They've replaced their CEO, but lo and behold, Five Below is down by 65% this year. Since I warned my readers it was overvalued back in January, but now it's interesting. In other words, everything depends on the price. It's still a great company. I think its problems are likely, the internal problems are fixable, and eventually the American consumer will come back. But meanwhile, now you can buy it at, 14 times this year's, significantly reduced earnings estimates. This is, of course, what happens when you buy into a growth story, that the growth slows and they miss the very high expectations that are set out there. You can very rapidly lose 2/3 of your money. But down here, with the stock having gone from 200 to, 70 something, I think it's pretty interesting. And, it's one my team and I are doing more research on. But it was a $15 billion market cap, sort of large cap company. Now it's down to $5 billion or so. It's now become sort of a mid cap. It's gone from a growth stock to I'm not quite sure I'd say it's quite a value stock, but it's still, the key is if it's still a great company and its problems prove to be short-term and or fixable, it's a pretty good bet to double your money. Like, that's the kind of stuff I'm looking for these days. I'm not spending any time analyzing Nvidia today.
So you're saying you might be
Hey
yeah.
guys, can I jump in and ask you a simple question?
Sure.
Does anybody know what the federal government's spending as a percentage of GDP is currently?
Spending? Yeah, I mean, it's
GDP, percentage of GDP, government spending.
yeah, it's approaching all-time highs, approaching World War II levels, right? It's in the
43%.
Yep.
The only higher mark on record is the COVID period where the economy collapsed,
Sure.
but government spending
Sure. Yeah,
continued. And so we're spending more than we spent in World War II, and we are not in recession yet. And we also already have $35 trillion in debt. We are genuinely approaching the point where there will be massive societal unrest because either government spending will not be allowed to increase, or else there will be a massive runaway inflation.
Porter, just to be clear on that statistic, is that total government spending, including state and local? Because I just Googled it because that number just sounded high. And in 2023, federal government spending was $6 trillion, which is 23% of our, roughly $24 trillion GDP. So are you looking at what's your number from?
So this is U.S. government expenditures as a percentage of GDP, and my source here is the Bank of America Global Investment Strategy letter.
Okay, U.S. government.
It must be total. It must be total government spending. Yeah.
Yes. Okay.
I didn't make this chart. It came from Bank of America's research group.
Yeah.
But I just think that we are so clearly on a completely unsustainable political path that if you have a big problem in the commercial with commercial real estate loans, and you have a problem in the regional banks, and you have a recession, and I think it's very clear we are already in a recession. We don't see it in and the nominal statistics because there is a high ongoing rate of inflation. So, let's say the GDP is 2.8%, but inflation is 3.5%. Well, you're in a recession, you just don't know it. And I think that you define that recession by the huge layoffs we've seen in construction starting in June, and the default rates in multifamily housing and credit cards and autos. So I think we're already in a recession. And I think that when tax receipts really fall, there's just going to be a huge problem. I would not want to be the next president.
Right. Well, the other factor, of course, is we're paying a lot more interest on our debt, and that's really spiked.
We're
interest.
spending more. We're spending more in interest, Tilson, than we're collecting in income taxes. Yowza.
Yeah. By the way, as you were talking, Porter, I was just curious. I pulled up from the St. Louis Fed. This is, again, federal government spending as a percentage of GDP spiked from 10% to over 40% briefly in World War II, came back down to 15%, really for the past 30, 40 years has been around 20%, spiked to over 30% briefly during COVID with all the government spending, to offset COVID, and is back down to 23%, a little bit above the last 40-year average, let's say 50-year average of 20%. But so it's gone up. This is something, I mean, the reason this doesn't cause me to become super bearish is because we're a very wealthy country. Our debt is denominated in our own currency. And also I remember what's called the Widowmaker trade, which is shorting the Japanese yen, and or Japanese debt. Is 20 years ago, predicting that it was all unsustainable. I agree with you. We are on a very dangerous spending trajectory, and adding to our national deficit $1 trillion every 100 days is an alarming thing. Sadly, though, I do not think the market is going to discipline us anytime soon. Japan was worse off than we were 20 years ago, and they still haven't had a debt crisis. So, as I look out over the next few years, this is not a U.S. government debt crisis is not high on my list of things that are going to shock the market downward.
Okay, so.
Yeah, I did a quick fact check. I feel like we're at the Democrat or Republican convention and people on the side are doing fact checks. I think the interest is not yet, it's $892 billion, which is now surpassed what we spend on the defense budget. But it is up something like 30% from 2023. So that's really, again, that's a pace that can't be sustained, and it does become worrisome. So,
and I think the real concern is you're going to see spikes in that number, but you want it to be because there's a recession. I mean, some people don't even want any Keynesians, but we have our government acts as Keynesians. They spend when there's a recession. They try to get out of it. So you're going to see those spikes when the economy is down and spending goes up. But it's concerning to see them now when the economy is still pretty good. Call it 3 months ago or whatever, when it was really good. We shouldn't allow that number to rise when times are good. That's what's really concerning to me.
Right.
Okay, so let me try and wrap up a little bit, just consolidate some folks' views here, because people watch this because they want to know, is this the start of a bigger decline? Is this a buy the dip right now sort of moment? And I think we've got a range of views here. Porter, so you have a lot of concerns over the long term, over the next 3, 5, 10 years, but pulling it in a little bit, you still think there are opportunities. You're concerned about those big cap tech names, but this 7-8% drawdown is not going to shoot down to 50%. Is that a fair assessment of your view?
I think that the returns in large cap equity will be very poor for the next decade. And I think if you buy the expensive tech names, the Nvidias, the Broadcoms, the Ubers, you're going to see very big drawdowns along the way to flat returns over the next decade.
And I agree with your position, Porter. One of the questions I would ask: would you do a weighted, equal weighted tech index? Like, do you still think tech is a good place to be in the next 10 years, or would you do more
I think that biotech is a fantastic place to be in the next 10 years.
Yeah.
If you want to know who the big winner from artificial intelligence will be, it's biotech.
Right.
It's going to completely revolutionize drug design and drug discovery and drug approval. It's going to make the businesses far more capital efficient and way better for investors. But my point is, guys, is that we are not going to see a bear market in earnings because there is so much fiscal stimulus. Companies are going to continue to be able to make money. What we're going to see is a bear market in multiples. I don't think if you've got a federal government that's essentially bankrupt and will have to print money in order to roll over its own treasury bills, I do not believe you're going to see interest rates that are sub 4% for very long. I think you're going to see interest rates that are 6 to 7%. And I don't think you're going to see multiples at 22 times. I think you're going to see multiples at 12 and 14 times. And once people have had their beatings enough times, when you have these 25% drawdowns in these big tech stock names, they're not going to be seen as one-way bets anymore. And eventually the market will move on from them. This is going to happen over the next 2 or 3 years. There will be big drawdowns and they will not reach new highs. And eventually the people will get worn out from them. And then, of course, they will move on. So you've got to stay away from richly valued, gigantic equity. And you've also got to remain open to the idea that innovation does continue and there are great opportunities and very many good businesses.
Whitney, how would you, we love disagreement here, and I think we all love talking through these things. So what little spin would you put on that? What would you change in your view?
Look, I think it's entirely possible we see a repeat of 2021 and 2022, which is 2021. We had the meme stock bubble and a recovery from COVID, and things got ahead of themselves, particularly tech stocks. And in 2022, the Dow was down 10, the S&P was down 20, the NASDAQ was down 30, and the average American's portfolio is down 44%. So, the scenario Porter is outlining isn't, you don't have to look back to the global financial crisis. This was only a couple of years ago. I can't rule it out. I don't think today things are quite as crazy as they were in 2021 when Cathie Wood was, the queen. I called her the bubble queen at the time. And I think you had a lot of artificial stimulus, coming out of COVID, and people were just sitting at home day trading their stimmies. But I think, as I said at the very beginning, at the very top of this show, if I were a trader, I would be thinking like Porter is and getting more defensive. If I'm a long-term investor, though, where what I'm really trying to avoid is a 50% drawdown, like we saw in the global financial crisis. It does not at all feel to me like we are like I felt at the beginning of 2008, where stocks had declined maybe 10% from their October 2007 high. And I just had a sinking feeling that things were going to get really bad. I do not have that feeling. My Spidey sense is not tingling the way it was back then. And so I think if you've got a solid portfolio of blue chip stocks, you're not too heavily weighted toward the tech sector. And in particular, if you'd have to pay big capital gains if you sold, then prepare for some choppy waters, but hang in there if you've got a 5+ year investment horizon.
I like that 2022 analogy, Whitney, because the markets were down 20%, but there were lots of names that were down 80 and 90%, right? So
sure,
if
Meta, one of the biggest stocks in the world, declined by 80%, top to bottom. But it was a unbelievable pound the table buy at the bottom. So get to know these stocks and look for stocks. As a value guy like me, you want to own quality businesses, but you don't want to pile in at the top when they're the most popular. You want to find babies that are thrown out with the bathwater. Companies like Meta at the bottom at $90 just a couple years ago. Things like Five Below, a quality retailer that's got plenty of room to grow over the next 10+ years, where the stock's been knocked down by 2/3. Now, really, the only question is does it have another 20-25% downside? There's a new CEO in there, and is he going to do a kitchen sink quarter and reset expectations even lower? So does the stock have another leg down? And that's something it's hard to know. But that's the kind of thing you want to think about. But eventually, the stock's a double from here.
Doc, you want to put a point on any of your outlook for here from any of those views?
Yeah, I mean, I would throw up one of the charts I threw up earlier here, the top 10 largest stocks in the S&P 500, the valuation of these on price to sales and price to earnings relative to their indices, S&P 500, Dow, NASDAQ. You really want to be on the underside of that if you're a buyer here. And then the other piece of it is I would just tell people probably should stick to stops if they're using the system that we have in our company, MarketWise Trade Stops, and this is not meant to be a marketing pitch today. This is meant to be an educational experience. But sticking to your stops. For example, if you bought Nvidia a few years back at 8 times earning or 8 times sales, and now it's up to 32, got to 35, you kind of have to say, I probably overdid what I was expecting. Take your money off the table. There's probably another tech stock or a group of tech stocks to get involved in it going forward. So I'm definitely with Porter on this camp in the overvalue sector. There's another chart here which is overvalued stocks. This is a bunch of them, again, price to sales going from 32 down to even Microsoft. And then you have to look at earnings. You have to look at cash flow on those businesses. Are sales stable? Do you think the sales are going to be stable? If they're not going to have stable sales in any kind of recession or collapsing sales, you got to get out of them because people in the market who are trading the market, we've seen this in one of our picks. We just got stopped out in Edwards Life Science. I mean, that's 23% return on invested capital year in, year out. I thought it was an aircraft carrier, and they say instead of 8%, we're going to see 6% growth. And they plummet a third in a day. So I think you got to be on your game now with both where your exit points are and then where you come back in. And economically, I think we're headed for much more disaster than I don't think it would be. Well, yeah.
And Doc, just a word or two on trailing stops there. We've been doing this for 15 years now, and we've tested every which way to sell. There's 1,000 books on when to buy stocks, and there's none on when to sell. You really can't do much better than trailing stop. It seems simple, but it works. Our friends at Trade 360, they use volatility-based stops, which are really important here because they adjust for the volatility of stock. So what it's really telling you is when a conservative stock has fallen a lot, something has really changed about the story. If a volatile stock has fallen a real lot, something has changed about the story. And that's what I think is happening with these big cap tech stocks. The story is changing, right? They're going to come outside their normal range. And so if you understand the volatility of the stock, you understand how it moves, you can use the price to tell you when something has really changed with the stock. Also, just to give people some specifics on how to survive these markets, the time to prepare for these things is beforehand, right? And that's what Stansberry Research is here to do. We're not concentrated in big tech. We buy high quality businesses all the time. We care very much about valuation. And so if you look at our performance numbers through this month, this is exactly what we've been preparing readers for. Over July, the S&P is down 5.1%. Our total portfolio is only down 1.4%. Our forever portfolio is up 1.4%, and even our quant portfolio is only down 3.8%, but that puts us now 500 basis points, 5% above the market, 13 months since launch. So, the investment philosophies we have here that Porter's developed, that Whitney's brought with them, that you've put together, those are the strategies that work in these kind of markets. We don't chase that bull market to the upside, but we have our protection in place from the downside.
Well, and interrupt you for a minute. Yes. And to Porter's point, so where do you look? Well, if capital gets a little cheaper or moves, it's going to move to places like biotech where the application of AI, which is hyped in every other manner I can imagine. We were out to dinner the other night, and we asked it, how does zucchini affect the body? And it gave the exact opposite wrong answer, and this was Gemini. And this was a simple question. It wasn't, and it's well known about what fiber does. So AI at some levels is total hype, but in biotech for drug development, we've already seen how quickly it's going to help. So there's opportunity there, and then in real estate, and we've got a guy now in our MarketWise group who's going to be fantastic with that. Porter has a love of this naturally as well. So I'm excited, But yeah, you got to kind of stick to, watching, being prepared and setting up and sticking to what you were doing, but look ahead, look a year, 2 years ahead. So,
any other specific actions you want to point investors to right now before we sign off, guys?
Porter, closing?
I just realized that the unemployment rate has now gone up for 4 months in a row. And over the last 75 years, every time that's happened, there's been a recession.
Yeah, when it's, I think, more than 0.6% up above its 6 percentage points above its what looks like a low, and it's at 0.7 on the latest tick, that's a recession, period. Right. So I think we're in the middle of it as well.
Guys, thanks for doing this. Hopefully we don't have to do it again soon. We get some healthy markets moving forward. But thank you very much. We'll talk to you all soon.
Thank you guys for coming in on your holidays. Sorry to interrupt things.
Markets never take a vacation.
That's okay. We're gonna bill you for an extra vacation day. Stansberry.
You're billing yourself.
Will you send that?
Darn it!
Send that to headquarters, please.
All right, guys. It was a great discussion. Thank you all.
Bye-bye.
Thanks, everyone.
Bye.